So if you're an investor scoping out the big players on Wall Street, you've definitely come across the name Apollo. But what is it, really? It gets thrown in the same bucket as private equity giants like Blackstone and KKR. But you know what? That's not the whole story. It's not even the main story. All right, let's pull back the curtain and really figure out what makes the Apollo machine tick. First, let's just wrap our heads around the sheer scale we're dealing with. As of mid-2025, Apollo is managing $840 billion. It's a number so huge it almost doesn't feel real, right? Puts them right at the top of the food chain. But the fascinating part isn't just how big that number is, it's what's inside it. And this, well, this slide says it all. This is the key difference. While its famous rivals are known for buying out whole companies, Apollo is first and foremost a credit investor. A staggering 82% of its assets are in credit. Now, for an investor, this isn't just some small detail. This is the absolute core, the secret to understanding their entire strategy and how they make their money. Okay, so here's our game plan for this explainer. First, we're going to move past that private equity label. Then, we'll look at the two different engines that power this thing, which leads us straight to the Athene Flywheel. That's the real heart of the machine. We'll then see how this specialist model stacks up against its giant competitors, and finally, we'll get to the most important part, the bottom line for you, the investor. Right, let's get into it. Section 1, more than private equity. And I'm telling you, the single biggest mistake you can make as an investor is to look at Apollo through that traditional private equity lens. They've built something else entirely. The Apollo of today, especially after it fully merged with Athene back in 2022, is really a tale of two companies in one. On one side, you've got the asset manager. This is the part that does what you'd expect, manages money, chases high returns. But on the other side, you have retirement services, which is their insurance company, Athene. Its job is completely different. It sells things like annuities, and by doing that, it pulls in these massive, massive amounts of long-term, super stable capital. Now, because of this two-pillar setup, there are two key ways they earn money that you have to understand. The first is fee-related earnings, or FRE. This is the really predictable, recurring revenue that the asset management side brings in just for managing all that capital. You can think of it as the steady, reliable heartbeat of the company, and Wall Street loves it because it's so stable. And the second piece, and this is what makes Apollo so unique, is spread-related earnings, or SRE. This is the profit engine from the insurance business. It's pretty simple, really. Athene gets money from customers, invests it, and makes a spread between the return it gets and the amount it has to pay out later. After the merger, this became a huge foundational source of recurring earnings for the whole company. So you've got these two big streams of earnings. But the real magic, what we're calling Apollo's secret weapon, isn't just that they exist next to each other. No, it's how they are woven together to create this incredibly powerful, self-reinforcing engine. And this right here is exactly how that engine works. It's called the Athene Flywheel. It all starts at step 1. Athene sells its retirement products and gathers billions in long-term cash. Step 2. That cash doesn't just sit there. It becomes this massive captive pool of assets that Apollo gets to deploy. Step 3. Apollo's specialized teams then originate their own private credit deals to invest all that capital. And finally, step 4, those investments earn money in two ways: stable fees for the asset manager and investment spreads for the insurer. And that success makes Athene stronger, letting it gather even more assets. And the whole amazing cycle starts all over again. So what's the result of this incredible flywheel? It's a staggering $498 billion of what's called perpetual capital. Basically, it's sticky money. It's not subject to the whims of fundraising every few years. It's a locked-in, stable base of assets that makes up nearly 60% of Apollo's total AUM. This gives them a structural advantage that is just incredibly hard for anyone else to copy. And that huge base of permanent capital is what really makes Apollo a different kind of beast. So to get a handle on just how different they are, let's put them in context. Let's see how the specialist among giants really compares to the other big names on the street. I mean, just look at this chart. The difference is just stark. Apollo is sitting at 82% concentration in credit. Even Ares, which is known for credit, is at 66%. And then you have Blackstone, the biggest of them all, with a much more diversified everything store model, at just 34%. It's clear Apollo has made a very deliberate all-in bet. And the hard data tells the exact same story. Sure, Blackstone is bigger by total AUM, no question. But look at Apollo's $690 billion in credit. It just dwarfs everyone else. And check out that perpetual capital line. Apollo is right there with Blackstone, which just goes to show you the immense power of that Athene insurance engine. They are absolutely playing a different game. So you can really think of the industry as splitting into two camps. You've got the financial supermarket model, that's Blackstone, where they offer clients a bit of everything. And then you have Apollo's model, the integrated specialist at scale, a company that has decided to utterly dominate one massive area, that intersection of credit and insurance. Which, of course, brings us to the final and most important section, the investor's bottom line. We've seen how the machine works, but as an investment, what are the arguments for and against it? The bull case is, well, it's pretty compelling. First and foremost, you have the Athene Flywheel itself, a one-of-a-kind growth engine that literally feeds itself. Then you've got these huge global trends in its favor. The retirement crisis is creating massive structural demand for the very products Athene sells. At the same time, as banks step back from lending, it creates a huge opportunity for private credit, Apollo's sweet spot. And to top it off, they're pushing hard into the private wealth channel, opening up a whole new multi-trillion-dollar market. But, of course, there are always risks. At the end of the day, the company's fate is tied to the health of the global economy. That intense focus on credit, well, that becomes a major concentration risk. With over 80% of their assets there, a big credit downturn would really hurt. And by swallowing Athene whole, Apollo has also taken on all the complex risks that come with running a massive insurance company, from interest rates to credit defaults to regulation. And this quote just gets right to the heart of it for any investor. The very thing that makes Apollo so powerful and unique, that deep, deep integration between the two businesses, is also the source of its biggest and most complicated risks. The bull case and the bear case are literally two sides of the exact same coin. So we're left with this one big question. Is this whole integrated model a masterstroke of financial engineering, a resilient, self-fueling machine built for the future, or is it a massive, concentrated gamble on the credit markets and the tricky business of insurance? Answering that is really the essential question for any investor looking at Apollo today.